Okay, good evening, everyone. And
That
good evening. And you are welcome to another edition of our lecture on on financial management. In today's class, we shall look at another topic that is different from what we've been doing before. Right. So we'll start today's class with business valuation. Though the method of valuation here, the free cash flow is not actually covered in your syllabus. So I will remove it. But for the purpose of today's class, we'll leave it like this, although it's not covered in your syllabus. Now, the first question is, okay, now let me quickly say this. So let me quickly say this before we continue our lecture. I have assumed that I've covered decision tree. Is now in the playlist, and simulation. Now, I'm supposed to take, is that now? Please mute your mic. Portfolio theory is also covered in your syllabus. But because I have a detailed portfolio theory pre-recorded video, so I won't take it in live. I won't do it in class. What you will do is to go to the YouTube. I will add the portfolio theory. It's pre-recorded. In fact, it won't take you within 2 hours. You are done. And I will add more questions to it, then update the folder, the Google Drive. Class, please pay attention. Oh. The decision making, the decision tree is on the YouTube. Decision tree. Monday morning, right? On Monday, first thing on Monday, you will see assignments. I will drop it in the general, in SFM, in FMM, what is it called, group. So I attempt question on decision tree. Then check simulation now is on the YouTube. Thirdly, portfolio theory, because I have a pre-recorded video for portfolio theory that it won't even take you much time. You just have to follow it and apply. So I will update the, what is it called? The playlists on portfolio theory. I will add portfolio theory to the playlist. Now, we can move to business valuation. When I'm done with business valuation, we'll go back to working capital class. Now, what is business valuation? Company value business. Why do we have to carry out valuation? For some of you that are into merger and acquisition, investment banking, investment analysts, portfolio managers, senior analysts can talk more about valuation, because directly or indirectly, they would have come across the how valuation work practically. Now, the question is, why do we value business? I will pick it from there. Why do we value business? Company value business. Reason for valuation. Why do we have to carry out a valuation of a business? It could be to be able to make share purchase. Of course, in financial modeling, you can build a model whether to buy UBA bank shares or not. If your valuation give you an upside potential, meaning that a profit, meaning that what is being expected for you to get from that investment, that is upside. If we give you downside potential, you will look at it that, oh, this investment does not work worth keeping it. You have to sell it because it is downside. Or if not, if you are yet to buy the shares, you look at it that this investment will not be good for investor. So you value business because you want to buy shares or you want to sell shares in the what? In the stock market. That is the one of the reasons or the purpose of valuation of a business. Two, you carry out a valuation because of tax purposes. If a company has not been paying tax in the past 5 years, sorry, please, I know. So, for the purpose of tax, you carry out a valuation of a business for tax purposes. For you to check if, or you want to calculate the total tax that are yet to be paid in the last 6 to 7 years. You have to carry out a valuation to determine the total tax. You can do that using valuation of a business. The next thing is for divorce settlement, whereby subsidiary or we want to liquidate, we want to go on our own. We don't want to, or when the business want to liquidate, divorce settlement, right? And they need to pay a liabilities to their creditors, right? So you have to carry out a valuation You want to know the value of the business. When you know the value of the business, you can now say, oh, this is the amount. From there, you need to pay your creditors. Class, are we still together?
Yes, sir.
Yes.
Excuse me. Thank you. Now, next. For the disposal of subsidiaries. When subsidiaries is not bringing enough fund to the business, for you to dispose it, you have to carry out a valuation. And that is MBO. MBO means management buyout, whereby you sell the subsidiary to the internal management after the valuation. When the disposal of subsidiary, when subsidiary is not bringing more funds, you are making a loss on that particular subsidiary company, you can sell it to the management staff. You can sell it. And that is what we call management. Management buyout. For the disposal of subsidiaries. You can also carry out a valuation to establish merger or takeover. Class. When a company wants to merge with another company, you carry out a valuation to know the value of the business. When you know the value of the business, you can now say, oh, it makes sense. We can merge. Because you know their value or the takeover. Merger means when two companies come together to become one. You can carry out a valuation based on that. For them to become one, you have to, you that you want to merge, or the company that you want to merge, or the company that you want to merge with, you have to determine the valuation of that particular business. Or take over, that is acquisition. Before you acquire company A, you have to carry out a valuation to know the total value of the business. Then you can go ahead and acquire. You have to understand the value. You have to calculate the value of the target company. They usually call it a target company. Class. You need to know the value before you can acquire the business. However, in SFM, I'll teach more on merger and acquisition. It's another topic on its own in SFM. You will get there, right? But it is also a form of valuation. It is because of merger. A practical illustration is Titan Bank. Titan Bank has merged with Union Bank. That is merger. And there are advantages of merger. Don't worry, that will be in SFM. But my explanation here is whether it is merger or acquisition. Before it can take place, they have to value the business to know the price, to pay for that business. You have to carry out a valuation of a business. To value shares sold in a private company, of course, even if they are not listed, or they are listed in the what? In the stock market. Yes, Unity Providos, Titan, and Union. Thank you. To value shares sold in a private company, whether it is listed or not listed, you want to know if you are to sell your shares, whether you are to buy or you are to sell or you are to hold. You carry out a valuation. However, there are different types of valuation you may carry out. Maybe discounted cash flow or the financial metrics. That is in real life, right? So, well, what I'm saying here is whether you want to buy, divorce settlement, the disposal, or to make share purchase decision, you have to carry out a valuation of a business. Class, are we still together?
Yes, sir.
Yeah, together.
Okay, I want to understand the reasons for valuation. We need to move to methods of valuation. Please pay attention. I'll be explaining the advantages of each of the methods. You may not see that in your notes, class. So that is why I believe in understanding of topic, financial management or strategic financial management or PM or whichever thing or whichever course is not difficult. What you need to do is to understand the principle. Then the principle is the rule of the game. So once you understand the principle, when you're given a question, you look at it, you start to look for that step, the principle behind that topic. Plus, I expect every one of you to have a principle book where you will open it, that we've done financial management, objective, cost of capital, where you will write steps, where you will write notes. Personally, that even a day to exam or a week to exam, you don't need to open textbook, you don't need to open pack, you don't need to do anything. You just stick to your principle book. It will help you a lot. Please get a principle or have a principle book. Now, the methods of valuation. The methods of valuation. The method of valuation, number one, we have the asset base. The asset base. If we have the asset-based method, under the asset-based method, we have the historical costs, the realizable, and the replacement cost method. The question will tell you what to do, whether using the asset-based or other method. Okay, or using asset-based method. Under the asset-based method, we have the historical cost, realizable / liquidation, or replacement cost. Class, what did you want to calculate? You want to calculate a minimum price that you will pay to acquire the target company, or the minimum price you will for the merger, what will be the market price of that particular business. That is the purpose. Any of these three methods, you want to calculate the market price. In some requirements, they will tell you the maximum price or the market price. You want to merge with A. What is the maximum price, or what is the market price of that target company? You want to acquire A. What is the market price? Because you need to value the business. You want to buy shares. You need to know whether you should buy or you sell. You want to dispose a subsidiary. You need to value it to know how much you will take it out. So any of these three methods, under the asset-based method, the calculation to determine the market price is the total asset minus the total liability divided by the numbers of shares. We give you the market price. Is that now? We give you the market price of that company. Then when you want to determine the market value, you can multiply the market price times the numbers of shares. The price means per share, per one. So whichever, any of these three methods you want to use, this formula of total assets to determine the market price, the formula of total assets minus the total liabilities divided by the numbers of shares, we give you the market price, the maximum price, right? Or the minimum price that you can pay for that particular for that particular company. Class. So the question now is, when the question says historical cost means the amount you buy, the original cost of the assets. Class, the original cost of the assets. You bought an asset 2028 or 2023. Class. Now, you are in 2025. What is the historical costs? What is the value then? Now, is it a good method of valuation? That is another question. Rejoice. You have a business. and someone want to acquire your business and the company is now presenting under the method of valuation, is presenting asset-based method. Particularly, is presenting asset-based method under the historical costs to determine how much the company will pay for your company. Rejoice, will you accept that?
No, sir.
Thank you. Brilliant. Historical costs, you are using the previous cost to value my business as at today, knowing that the costs of that you would have appreciated. You have to use based on what is happening now. So historical cost does not consider the current value of an asset. So therefore, is not a good method of valuation of a business. I can't accept it. I have to reject the offer. Can you use historical costs? Now, under the asset-based, we have the realization or liquidation. Usually, this method is used to value a business when I want to acquire Rejoice business and I look at it that they want to liquidate. They want to liquidate. They want to know the market price so that the value, so that I can come and pay for it. You know, I will be the one to bring the bid. Me, as the main company now, I will present a bid to Rejoice that I want to buy over or I want to merge. Probably Heritage Bank could have merged with other banks. They will not have liquidated, right? Even only if, but even only if they would have they have taken that decision. However, who want to merge with such company? They have to come and merge. They have to. Heritage Bank need to come and merge with other banks. But before you can merge, you need to see some advantages of merger. If you are not offering something, I cannot just because you are facing a financial issue, then I say you should come and merge with me. No. I need to know. I need to get a value. I need to know what the company is adding to my own company before I can take it over. So liquidation means when a company is planning to fold up, they need to value a business. Class. They need to value a business. Then they use liquidation. Liquidation value make use of, what they realize in selling that particular asset. As of today, plant and machinery may worth 15 naira, but because they want to liquidate, oh yeah, everybody, they will now say, under the real estate guys, they will call it forced to sale. Something that's worth 15 naira, you end up selling it 20 naira. It does not show the true value of that business. Class. Realization. What you realize when you sell your assets, it will be given to you in the question. what you realize. This is what the company realize. It will be given to you in the question. That is liquidation plus. So the formula still remains the same. What will be the market price? What you want to calculate is market price, or the market value. When you get market price, you get market value now. So the total asset minus the total liabilities divided by the numbers of shares, right? We give the market price that you can pay for that for that particular business. Either it is merger or acquisition or disposal. Replacement cost. Replacement cost consider the current market price of an asset. The replacement cost consider the current market price of an asset. But is it good? So it is only assets, right? It can be accepted to some extent, because time value of money, things changes. What you value today under the replacement cost, tomorrow it might be 20,000. You can see class. Replacement what? Replacement cost. You'll be given in the question that the current price of the asset or the current cost of the asset is this. The question will state, use asset-based method. In fact, they will even mention it, the historical cost, realizable and replacement costs. In some question, not at this level though, right? Let me don't mention that part, right? Let's just move like this. Under the methods of valuation, we have the income-based approach. The income-based approach. The income-based approach make use of accounting profit. The income-based approach make use of accounting profits. You and I knows that accounting profit is subjective. Class. Income-based approach. Oh, wow. 1%.
Hello, are we still there?
I think you lost network.
I think so. I think so. Let's wait for him.
We lost him to the network, right?
Hello, class. Can we continue? Sorry.
Yes, we can continue, sir.
Okay, that's fine. So, under the income-based approach, you and I can agree with me that this is accounting profits. And an accounting profits is actually subjective. So, how do we determine the market price? Under the income-based approach, there are also 2 to 3 approach to determine the market price. That's you will pay for that particular company in valuation. Either you use the price earning ratio or earnings yield, dividend yield. So we'll look at it one after the other. So when they said you should mention what are the disadvantages of income-based approach, one of them is it is accounting profits. An accounting profit is subjective. Class, how do we determine the value? Anything you want to do under business valuation, you want to calculate market price, the amount you will pay for that company, either it is merge or acquisition, and some other reasons for valuation. You want to determine the market price. Class, then the price earning ratio is equals to market price over earnings per share. Class, you can cross multiply, is that not so? When you cross multiply, you have market price equals to price earning ratio times earnings per share. You have your market price. Class, what is the formula for calculating earnings per share? The profit after tax minus preference dividend divided by the numbers of shares, ordinary shares. We have the earnings per share. If I thought there is preference dividend, you minus it. The income based makes use of even investment ratio, basically, right? So all you want to do is to determine the market price that you will pay for that business. Of course, you have to value it. You have to know the what. When you value it, you will now know the amount that you want to pay for that particular price, for that particular company. Even when you want to buy shares, when you value it and you look at it that this is the amount I'm supposed to buy, then it is not giving you what is supposed to be. And I used to tell people or an investor that the market price of a business is different from the value of a business. Class. Now, practical now. When you go to NGS today, you will see the market price of each of the stock. The market price you see is not the market price you are calculating here. Oh. That is just the stock market price. Then, what is the value of the business? You have to carry out the valuation to know if that market price that you see in the NGS, is it overvalued or undervalued? This will take us to portfolio theory. I believe you will enjoy that video because it is practicable. What I'm trying to explain here is that the stock market price, if you go to the market NGS today, the stock market price you see there is different from the value of a business. The stock market fluctuates on a daily basis, reacts to the market, while the value of a company is for long term. The stock price is for a short term. The value of the company is for a long term. You have to do a valuation to know if you should hold your stock or you should sell or you should buy more. Then you need to compare the stock market, the price in the stock market and the value of the business. If I don't start to explain valuation. I mean, let's just move on to this, right? I believe you will understand the portfolio theory. Portfolio theory will teach you whether it is overvalued or undervalued. Please, you need to watch the video. I will update it immediately after the class. You have portfolio theory 1, portfolio theory 2, and the portfolio theory 3. Class. So the market price here is the market price, is the value of the business. Class. Don't forget that this is market price per share. You can calculate the value by multiplying it by the numbers of shares. Market price times the numbers of shares. Class, who is against me in this class? Are we still together? I hope we are not sleeping, Abby.
Together we are, sir.
Okay, is the class boring?
At all.
No, sir. No, sir. It's not.
Okay. That's fine. If it is financial management, I have a lot to give out. All right. It's my interesting to know that this particular class, I just prepare it. I think 10 minutes to the class. I just say, what did I want to even take? I have to just check. Just 10 minutes. I just have to check the syllabus. What is happening here? What is okay? We have to take business valuation. I already have portfolio theory as recorded so that we can move. We still have our working capital that will still take much of our time as well, right? So the market value, market price times the numbers of shares. Under the income-based approach, don't forget all these things make use of accounting profit, and it's subjective. That is where we can counter the income-based approach in valuation of a business. I know at the end of this topic, at the end of these methods, we will now ask, IB, which of these methods safe? Is the best method to value? There is no accurate method. However, Warren Buffett You cannot use accounting profits to value the business. Accounting profit is subjective, and I agree with him. We'll get there as we move. We'll get there. Now, earnings per share. You use earnings per share? Oh, sorry, earnings yield. And what is the formula for the market price? You can make it the subject of the formula as well, because the question will say using earnings yield. All right. So when you make earnings yield the subject of the formula, you have the price that you will pay for that business. You can multiply it by the numbers of shares. It will give you the value that you will pay for that. So you cannot compare that value with the stock market price. So you will now look at it. Is the stock price overvalued or undervalued? If it is overvalued, what does that mean? If it is overvalued or undervalued, what does that mean? So when you watch the video on a portfolio theory, you understand. Right. Now, the dividend yield plus the market price is still the market price. Just make the other one the subject of the formula. You will add the market price that you will be willing to pay for that company, for the target company. Of course, in the process of valuation, they need to give you the necessary documents to value the business, whether it is merger or acquisition, or in a listed company when you want to buy shares. You can get information from investors relations, you can get information from NGS, you can get information for Yahoo Finance, you can get information for investing.com. There are different finance places that you can extract information in the process of valuation of a business. Class, if it is merger, the company need to give you their information, and they should know that they should ensure that they are compliant with with the SEC, because there is a regulatory there is a sector that regulates the service. Now, dividend yield as well, you have to make it the subject of the formula. You have your market price. So the examiner can state that using the income-based approach and mention the approach under the income-based. So you should know that, okay, this is what you'll be looking for from the question for you to determine the market price. The market price is the market price of the company, or the market value. You can say market value. When you multiply by the numbers of shares, we give you the market value of that company. That is the value of that company you will be willing to pay to acquire or to sell or to buy that company, or to buy or to sell the shares. Class, am I communicating? Now, are we still together?
Yes, sir.
Okay. Another method of valuation is dividend valuation method. Dividend valuation method. One of the disadvantages of this method, it assumes that it is mainly used for a dividend paying company. Plus, it is only when a company pays dividend that you can use this method to value the business. In Nigeria, we don't have such company that is not paying dividend. However, we have, I think, Facebook, right? I think I recently wrote about companies that pay dividend and does not pay dividend. I've even forgotten themselves. Right? You can check my post on LinkedIn, it's there. Right. So, company that does not pay dividend, you can use this method to value their business. There must be dividend paying company. That is one of the disadvantage. And how do we determine under the dividend valuation? We should not forget that there is dividend with growth. When you want to determine the dividend without growth first, that the dividend will be constant. How do we determine the market price, the value? Don't forget, market price means per share. When you multiply it by the numbers of shares, we have the value of that company. So you can make market price the subject of the formula. When you make market price the subject of the formula, you can cost multiply. You have market price times KE, then the market price equals to current dividend divided by cost. You can see that. What did you observe? You see that what we've been looking for is a price, market price, market value, market price, market price, market value. That is the valuation. That is the purpose. You need to know the value of that business or the market price. What would be the market price of the company? Not stock, market price of the company as a whole. Right. So the dividend with goods. So it is assumed that the dividend with what? We grow over the years. So how do we determine? We remember this formula under the dividend with growth, under the cost of capital, right? Right?
Exactly.
Okay. So the market price is still making the subject of the formula. Market price equals to this, the cost of equity minus growth rate. You have the market what? You have the market price. When you multiply it by the numbers of shares, you have the value of the company. Class. So this is under dividend valuation. We have the asset based as a method of valuation. We have the income based as a method of valuation. Then dividend valuation method as a method of valuation. It's my interest to know that economic value added is a method of valuation. Ever. It's a method of valuation. So don't let me bring all those ones here. Right. When in SFM we'll meet and we'll have a discussion on that, right? So now, which of even this method? We have the discounted cash flow. Your syllabus did not cover free cash flow, but it covers discounted cash flow. So when you are valuing a business, I will put more note. I will have to remove free cash flow. Yes, I'll put what is it called? Present value of cash flow. I'll just put present value of cash flow. I'll do my research and check if you will need either free cash flow to the firm or, but I'm very sure you will not need free cash flow to the firm or equity. But guess what? I'll prepare you for the worst case scenario you may even see in the valuation of a business. Valuation of a business will not be a problem, honestly. Right. Now there is discounted cash flow. If they say something is discounted, it makes use of cash flow. It does not make use of accounting profit. You need to discount it. It makes use of what class? Discounted cash flow. You can ignore this free cash flow to the firm and equity. I'll check, and in our next class, then I would have updated the drive, or maybe after the next lecture. But you should understand that there is a discounted cash flow method of valuation that consider the cash flow, not accounting profit. Plus, it consider what? Cash flow, whereby you need to discount your cash flow to the present value. When you get the present value, that present value becomes the market value of the business. Plus, I hope I'm communicating. Discounted cash flow method. Discounted cash flow method, where you need to discount your cash flow, your future cash flow, to their present value. Either you use weighted average cost of capital or the cost of equity. In our next class, I will find out whether we'll make use of free cash flow to the firm or to equity. But understand that there is discounted cash flow method under the method of valuation. And this is the cash flow that was adopted from this man that says that the method, because cash is king, the method you will use to value a business, right, that will show relatively good value to some extent, is the discounted cash flow. While other approaches, the income base is subjective, make use of accounting profit. The dividend valuation, you can only use it to value companies that are paying dividend. The asset-based, historical base cannot be applicable, then the discounted cash flow. So when you discount the cash flow to the present value using either the weighted average cost of equity, weighted average cost of capital, or the cost of equity to determine the present value of the business. That present value of the business is the value of the business. Class. What are other methods? Is what we call enterprise value. Even at professional level, they don't test enterprise value, but let me just include it. Enterprise value, when you want to determine the value of the business overall. Class. The market capitalization of equity plus total debt minus plus minority interest. Of course, we know that under the group. In group accounting, minority interest plus preference dividend minus cash. You don't acquire cash. So we give you the enterprise value. We give you the enterprise value of the business. That is the market, that is the value of the company. Then we have the EBITDA multiplier. Your enterprise divided by the EBITDA will give you the market value of the company. Even at professional level, it wasn't the method that they usually say, even at the professional level, is the asset base, the income base, the dividend, the free cash flow, which is the discounted cash flow approach. Right. So, class, I believe I've explained the method of valuation of a business using different approach. We also have the debt part of it, but most times they don't use all those things. Can only use it theoretically. But in our next class, I'll try as much as possible to see if I can add all those redeemable, the market value of the redeemable, irredeemable, all those things, and add as part of valuation. But practically, we don't need all those things to determine the value of what? Of a business. However, when you want to take over a company or you want to acquire a company, plus when you want to take over, you can agree with me that the total value of a company, total value of a company is equals to total market value of equity plus total market value of what? Of debt. Value of debt. We give you the total value of that company. The total market value of equity plus the total market value of debt. We give you the total value of that company. And you should know that when you want to take over a company, you have to, you see that debt that they are owing, that debt, you have to remove it. But if your syllabus cover that, we'll push forward for that valuation. But you should know that when you want to take over another company, am I taking over your debt? Right? Am I taking over your debt? So most times, the value of debt will be removed from the total value. If at all you have a debt that you need to pay, we will get there. As we move, we solve question, you get to know more about valuation of a business. But by my message here tonight is that there are different reasons for valuation, a different method of valuation of what? Of a business. So you can unmute your mic if you have question for me quickly. Although this is just an introduction class, we'll still have more discussion on valuation. Okay, Stanley.
Yeah, yes, sir. What's the meaning of that EBITDA multiplier? Does it have a particular
Earnings
meaning?
earning before interest, tax, depreciation, and amortization. It is used to
Okay, sir.
determine the value of a business.
Okay, sir. Thank you, sir.
You're welcome.
Good evening, sir.
Good
Sir,
evening.
please, this topic that we are treating is not under investment appraisal, abi?
No, investment appraiser. Okay. I've left investment appraiser since.
Okay, sir.
This is business valuation. Oh. I think this covers about how many percent of the syllabus? How many percent?
15.
Okay, 15%. Okay. That's fine. 15% of the syllabus, so that's fine. So any other question? Yeah, I don't think I can solve question this night, too. Because as I did like this, I just want to do introduction. So I'll come back to any other thing. So that you can go back and check, watch the video again, so that you will have an understanding of the valuation. So Silas. Silas, quickly. Silas, do you have a question for me? You're muted though.
Can you hear me, sir?
I can hear you now.
Can you hear me?
Okay, I know they use bedroom voice for me. I can hear you
Thank
now.
you.
Abi your network me. Ajayi.
Yes, sir.
You want to see your babe. Which one be? Can you hear me? That talk loud. Ajayi yeah, now.
Okay. This market price, is it same thing as total value of equity?
It's not to it's
Okay.
not total value of equity. Oh. Now don't start to are you in this class since morning? Have you been in this class? Like, did you start this class with us?
No.
Okay, no confuse us. So the market price is market price per share. The market price is the value is the based on the value of the company, right? So when you multiply it by the numbers of shares, we give you the value. This is company. You are valuing a company. You are valuing a company, not stock. Not you want to get the market value of equity. When you say market value of equity is for the stock, not for the company. This is company. You want to value a business. I'm not supposed to explain again, sir. Just check the YouTube again. I've explained this thing. Ajayi, do you get?
Yes, I get it. Yes, yes.
That is why I've explained that there's difference between the market value and the market price you see, or the stock price that you see in the market. They are two different. The market value means the value of a company. Stock price can change at any time. Market value of a company does not change at any time. It is for a long time. Right. So when we solve question, I believe you will have an understanding of it. You get. Thank you. Silas, quickly.
All right. Can you hear me, sir?
I can hear you now.
All right. My question is based on that historical cost model under the asset model. You say that it's not really advisable for a company. Like, is it a buyer to use historical model?
So
So I wanted.
if now you can you use it? So you now present it to me, then I will not tell you that, oh yeah, well, let's accept the bid, the play. Now
Yes.
continue.
Okay, I'm just saying in a case of, for example, like based on the economic now, like the inflection rate, like for example, a vehicle that you value at the rate of 2,000 naira, maybe last 5 years, it cannot be valued the same amount this year.
Mhm.
So it's on the benefit of the buyer.
Oh, the play. In general, asset base is not, it's just is an asset, right? Usually, this is what they normally do. If you present asset based, you present income based, you present dividend valuation method, you present discounted cash flow, they usually pick the higher. Is the higher now? You check the one that is higher out of this method, pick it and say, okay, the maximum price that this company should pay for this company is 2 naira. Is discounted present value or this discounted cash flow because it has it has higher market price or value than any of that what method. Let me just tell you now, the asset base, income base, dividend, when you use discounted cash flow, discounted cash flow market price or the value usually higher than all those things. Usually higher. Let's say the value usually higher than even the price, usually higher than the asset, income base, and dividend because it's based on cash flow and it is based on projected as okay, they will have this in the future, they will have this in the future. So you have to do it the normal MPV, the way we normally do present, but it's going to be a cash flow, right? It's going to be a cash flow approach. Do you get? Silas?
Yes, I get your point now. Thank you.
You're welcome. So, class. So I think I need to go, right? I beg.
No,
or the plate.
no. Tell that auntie that you are staying with us today.
Just the plate. So under the valuation, we still have efficiency, market, hypothesis. All those ones are theory now. I will add it to the notes when I'm sending the notes. Efficiency, market, hypothesis. I will add everything to there. You have to read it. Is a valuation of a business is an interesting topic, and it will not take us more than 2 to 3 classes. Then we are done with valuation of a business. We'll make sure we take questions like 2 to 3 to 4 questions. Then we move. Right. So please, immediately after this class, everything is on YouTube. I will update the playlist now so that I will add the portfolio theory to it. Class, question.
Hello, sir.
With you.
Sorry, there's about 3 videos you say you want to upload. Please, can we get the names of the topics?
Which one? The decision tree is there already. Have you checked YouTube today? Okay, let me show you. Wait. Let me
Not
show
yet.
you. Wait now. Wait, make I show now.
All right, sir.
Mhm. Simulation. I say simulation and decision tree. I'm coming.
Let me write.
Simulation, decision tree, and portfolio theory. Can you see my screen?
Yes.
Yes, sir.
Okay. Don't even worry. No,
Hmm?
no. Uh,
You say what, sir?
Mukuna, no worry. I will say it with mouth.
Jesus Christ.
Simulation.
All right, I have taken
Simulation.
note of that.
Yeah, check simulation. You see it there. Hmm? It was added
Which
with.
one?
Check the playlist, FM playlist. You will see I use. Yes, there is material for portfolio theory now, but I have to add questions to it. I will do the work this weekend. I will add questions to the portfolio theory. I will update the drive. First of all, go and watch the video first. That video service, see the same thing that anything that is in that video is in my notes. Actually, I'm the one that do the pre-recorded video, right? So if you check FM playlist, you will see SFM/FM, SFM/FM2. You will see decision tree, SFM/FM. You will see simulation, SFM/. You will see it there. That's why I slash it so that you will know that you need to. Then I will now add portfolio theory. Business valuation. This particular one that we're treating now is already on YouTube. I will add it to the what is it called? Please make sure you go back to YouTube so that you have idea of what we did today. It's very important. Okay. Stanley, before we go quickly. Okay. So class, can I
Sir,
go?
I'm sure it's an error, sir. Sir, I'm sure it's an error, sir. Thank you, sir.
Okay, that's fine. Class, can I go? Am I free to go? Let me go and
Yes,
meet.
Yes.
sir.
Let me go
Thank
and
you,
meet
sir.
That auntie.
Don't
my
worry, don't
my
worry,
sugar
we know.
my sugar mummies.
Don't worry, we know.
Uh,
Yeah.
well,